Good morning, everybody. Welcome to the Wednesday live stream. Apologies for our typical 4 minutes, 5 minutes to being late. Just getting our guests settled, everything's set up here. All's well, all's well. So let's see. Joe, the intern, is in the house. You guys gave him some props in the video for last night. Thanks, buddy. As I told you, if anybody in the world out there needs coffee, let us know. Joe's your man. He'll make it happen. I got to get rid of this microphone. We got to come up with a better solution. Okay, so listen, future's coming off here a little bit. Kind of tailing off the end of earnings season. We're entangled in tariff wars. Markets are kind of sideways here. So let me just go over to the comments section here and make sure everyone is rolling. I can see your comments, questions, and insults. Bring them all. Not afraid of it. There we go. Top of the morning. Hello, all. Oh, you know what? Intern. Yes. Where's that bottle of bourbon? I don't know. Somewhere over there. We had a nice present from a customer. Don't worry. We're not going to start drinking it 8:50 in the morning. I think it's over there. We had a longtime customer drop off a nice bottle of Woodford Reserve, which we really appreciate. Say hi to Joe, the intern.
Hello, everybody.
There you go. Look at that. That's customer appreciation. Here, don't drink that. Not until 10 o'clock and the webinar is over. Anyways, let's bring Terry Long in, our trusted associate director of something at Trading Analysis, man of all skills. Engineer.
Good morning, Todd. Good morning, guys.
You're chief engineer at Trading Analysis, right?
Okay, I got a promotion, I guess.
How you doing?
I'm doing great. How about you? I see you in your Bermuda shorts.
Oh, yeah, we got
springtime finally come to upstate New York?
No, it's not springtime, but it's not 40. It's at least not 40. It's probably 60, which means it feels like 80.
Oh, man. Well, it's 80 down here, so just enjoy it while you can.
Yeah, no, it's good. It's good. All's well. All's well. Lots happening here, guys. Again, I know you guys are here for just good market information, but we've got an office coming. We've got a new COO in the house, good friend. You guys will hear from him. Just trying to organize this awesome team that I have. Not organized, but basically run this business like a real business. I'm more of a trader and a market analyst, certainly not a business owner, so I'm trying to figure that out. So all's well. Got a good team going. Things are getting set up, and all's well. So that's that. Other announcements. Today's Wednesday. Member webinar at 10 o'clock, and then I am on CNBC tomorrow. Fast Money at 5 o'clock, 5:15. Technicals at the top of the show. Other than that, Terry, what's going on your end? Anything, or you want to dive into these kind of confusing markets?
Let's get into the market. Let's see what the sideways markets are. I think we called it more than a year ago. We were headed into this butterfly heaven.
Yeah.
So that was my terminology for it. And certainly I've been seeing a lot of setups in a lot of different markets. In your webinar last night, you talked about the healthcare, and it just reminded me more about that moving sideways. So, yeah,
there's a lot. But please, sorry, didn't mean to interrupt.
No problem. I was just going to say I think that's the wave pattern that we've got to deal with here, and it's rough waters. It's just like being out on the ocean. You see the waves coming in and out like that. It's not easy to navigate. So
no.
So that's why you're the captain of our ship. And
isn't that sweet? You're nice. So one of our main strategies that Terry has been talking or was just referring to is kind of the idea of when you have context in the market that we're not trending, but in fact we're correcting, your tactics have to switch. And the tactics from an option trading point of view is to start to reduce those deltas. And deltas are your directional exposure, like how long what's your bias of the underlying option position. If you have high positive delta, you want the stock to go up. If you have strong negative delta. You want the stock position to go down. We've been in favor of kind of reducing the deltas, whether positive or negative, getting them closer to zero. And as you do that, you start to not only pay less theta, which is that kind of ice melting below your feet with your long options, but starting to skew that towards the positive, which is making money using the decaying nature of options. So that's why I like butterflies, guys, which basically, all you're doing with these option butterflies, and let me just come up with an example here. Who here in the crowd, in the viewers, is an options trader but doesn't know butterflies? I only have four screens here, and I've lost my windows. I need more screens. Again, option traders in the house right here who trade some options, whether you're buying options outright, maybe you're doing some spreads. Who here is not so sure about butterflies? Don't be shy. Yeah. Throw it in there. And also, I always forget to say this at the beginning. I always say this at the end. I forget to say at the beginning. If you're watching now, go ahead and hit that thumbs up button if you appreciate our ridiculousness, and maybe throw a comment in there below. If you're watching on the recording, please hit that thumbs up button. Let YouTube know you like what we're doing, and we'd appreciate that.
I tell you, Todd, you introduced me to butterflies. Even though I was sort of self-taught in options, I was always too afraid to explore strategies because it didn't have anybody to guide me through a real-world application of it. Yeah. I mean, you can read books and stuff, and it sort of makes sense, but until you actually see someone execute it and practice it, then you understand the nuances.
Yes.
So,
yes.
Yeah, I'll admit that I was just a buy and lose money, buy a put or buy a call and lose money all the time option trader until I joined up with you and actually started learning the correct way to apply the strategy. So,
I appreciate that. I appreciate that, and I do actually pay him to say that because he's employed at Trading Analysis. So full disclosure.
Yeah, but it's the truth.
I appreciate that. So what we've been talking about, and something. Sorry, we've been very. I appreciate that again, Terry. We've been very inconsistent with the schedule here. Is we have been tracking a sideways market. Really, if you go back. This is the same price as the S&P was just before we made an all-time high in January 2018. So you're talking 16 months ago. We've been very sideways. So if you want to be, tactically trend trading, you've got to be really on your game. You've got to be in. You've got to be out. If you're a buy and hold investor, it's tricky in here. You've got to be active. I think the return of the active investing is back, and passive is no longer. It was easy to say active trading was done when you had just a beautiful straight up bull market for 3 years. Well, now we're coming on a year and a half of kind of sort of markets that would cause most money managers to pull their hair out. So you have to shift your option tactics is what we're saying. So the whole idea with this is, let me see what's the easiest way to do this. If I could just show you on the options platform here. We do have a guest coming in. We've got a fun guest, a friend of mine. We'll introduce him here. I just texted him that I'm 5 minutes late because I was fashionably late to the webinar, and I apologize. But the idea of a butterfly is your typical spread, which is buying a debit spread and also selling a credit spread. And it's kind of redundant when somebody says buying a debit spread because a debit inevitably means it's costing you money. A credit inevitably means you're being credited money, so you're selling. So the industry has just kind of shifted over the last couple of years to saying buying a debit spread, selling a credit spread. So what's a debit spread? So if the SPY is right now trading 286 at the close, now we're down a solid $1.20 here. We've got some pretty good pre-market action here. But if we're trading 286, let's go 30 days out. A standard credit spread on the call side would be buying the 280. Let's put it right at the market. Buying a 286 call and selling a 290. Okay, so if you do that, if you go buy a vertical, buying 286, selling 290, and you go over here, you go to the Analyze tab, NSPY, I've got to get this other stuff out of here. You know, you want the stock to go up. This is your profit zone between 286 and 290, your short strike. Above 290, your risk or your reward is capped. Your risk is also capped on the downside, okay? So this is the debit spread portion of a butterfly. Over here, if you go back, we could also add a credit spread on top of that. And the way you do that is you would just basically sell, okay? You could sell another 290, okay, so which would make you short of the two of the 290s, long one of the 286. And then why don't you add another one on top, a purchase of a call strike $4 higher to make you long two and short two, and that would just be an example of a balanced butterfly. So if we go over here and we sell the 290 call, sell vertical, sell the 290, there's our extra sale of the 290, purchase of the 294, and you analyze the trade. See right here it says credit, analyze trade. So now as in effect what you're doing is you're short one at 290, another one at 290, long one at 286, long one at 294. You've defined an area where you want this trade to be. This is your butterfly. And this is basically a range-bound strategy, which I think has been, as Terry mentioned, the focus of what we're trying to do in these markets because we are, at a higher time frame, very range-bound. Now, you can move these around a little bit, and I'll get to current markets here in a sec. I'm going to delete this combination of a debit spread that's paying $2.34 and a credit spread that's being, you know, $1.56 is being received. I'm going to get rid of this and just do it the traditional way, which is just going to be like this. Let's do a 290 butterfly. All right. So there's the sale of two of our 290s. Let's kick this one down $4. Let's kick this one up $4. If you analyze, it's going to be a debit of 78 cents. That's all you can risk. $78 if the S&P crashes lower, or $78 if the S&P crashes higher. But if we stay in this zone, this is the profit you can make, potentially 312. And the idea is you want these 290s to expire or melt. You want the lower call to hold some value, and because 294 is higher out of the money, it'll have less delta, and you want that one to expire. You want that one to expire or worthless. So the problem is, I shouldn't say the problem, this guy will be a cheaper one, so it won't hurt you as much. You basically want to stay in this range. The point I'm making here, guys, is based on the context that you have, and I'll show you a couple examples here of what you think the market's doing, you can move these strikes around just moderately and change the position delta. Right now, this is a slightly delta negative trade, minus 1.23, making 67 cents a day. What if we think that, you know, let's say overnight, we put this trade on yesterday. Let's say we think that we want to make some room on the downside because the S&P might drop, right? The way you can do that is you can actually move the calls up and bring in less positive delta. Make that more of a negative number. So if we go to 286, let's go to 287. Watch what happens to the delta, and watch what happens to the shape of the P&L curve. Now we have minus 4.43 delta, and it's a little bit more of a bearish trade, right? So kind of moving these around, even I could go to 288, and you're going to see, okay, now we've got more loss on the upside, a less loss on this side. You can kind of move these around a little bit and structure them such that they're positive delta trades if you're bullish, or negative delta if you're bearish. Hopefully that makes sense. So that's basically what we're doing in here. And as I put in the YouTube video last night, you know, one of the main positions that we've had here is I believe we're in a B wave triangle here in the S&P, and we might be ready to be about done. Terry, what do you think? Are we done in that triangle? I mean, especially it's with the futures down, actually only down 0.4 now, so it's not as bad as it was.
Yeah, I don't know whether the end of the pattern is complete. I was expecting a sharper drop close to the market close yesterday and didn't really see it. So it's a little uncertain to me as to whether we pinned that A wave or not.
Yep. Okay, so
I did want to say one thing about the butterfly.
Yeah.
So we showed you how to open the position, but it's also important to understand the fact that the butterfly is made up of two separate verticals. Because sometimes that comes into play when you're closing out. Because you want to close out the in the money trades, but you don't need to spend resources selling the whole butterfly if you're not pegged in the center. So just understand that you can always break that trade apart when you're closing it.
Exactly, and that's what we did yesterday. I did a trade with Jeff Kennedy of Elliott Wave International. Costco has been in a pretty tight triangle. We basically identified that this could be some kind of funky, crazy fourth wave. It's probably more complex, WXY, for those of you who are Elliott Wave fanatics like we are. But it's been sideways. We took the profits and we've begun to move higher. So we actually adjusted that trade into just simply a long call position. We left two of the long calls from the call butterfly, and I can show you the exact trade that we did. But we have just two of the 250 calls left. So if you go over here to account statement, and I can just show you the exact trades we did here in Costco. On 5/7, May 7th, we bought the butterfly for $344. Sold most of it for $460. You'll notice I did 5 butterflies here, sold 3. I kept 2 of the long calls just to express kind of a bullish bias here because the consolidation in wave 4 is likely over and we might catch a bit of a push up. We'll see what happens with this broader market. That's been one that we've done, and the other one is Disney. Disney is still going. We've identified the end of the trend, which if you look at basic Elliott Wave, you're looking at a Fibonacci multiple of 1 compared to 3. And you don't know exactly where it's going to end, but if you look at 200%, 261%, 1618, these are typical stopping points for a wave 3. If a wave 3 is done, the big breakout move is done, okay, now you expect the market to take a bit of a breather in wave 4. Okay, and that's your opportunity to put these trades on. Right, so Disney, if you look at wave 4, what's a reasonable time that wave 4 might last? Well, you'd want a foundation. You'd want to compare the distance of the last correction of the same degree, which happens to be the minor degree, to serve as your basis. Now, if wave 1 is incorrectly placed and it's going to go here, okay, watch what happens. Equality, meaning time elapsed in green 2, would be equal to wave 4 here on May 28th. A 1618 would be June 24th. I don't think that's the correct count. I could be wrong, but if that's the case, we should have longer to go in wave 4 because in the Elliott Wave world, you need the right look. So that's just kind of the trades that we're doing. We're doing butterflies and strong stocks while the market is under pretty considerable pressure right now. This might be the key, as I said. I don't want to skip too far ahead here. I'll finish up with the S&P here before we bring the guest in. But Disney right now, you can see we're doing pretty well. The market's going sideways and up $879. We've got a butterfly centered around $133, $10 on either side. It's a balanced butterfly. Max profit would be just about almost $2,800. Right now we're at $800. We have 2 weeks to go in this trade, and the longer we're in this trade, the more that theta right here is going to move up, which is decay. And I think that's kind of the key in here is to, if you want to kind of generate some income with butterflies in strong stocks like Disney, like Costco, like Lululemon, like Twilio, I think that's the kind of the way to play it while the S&P is under pretty considerable pressure. We're going to be watching this. Terry and I are going to be watching this very closely to say, is this thing over? Is this, as Terry said, just B, we've got one more move up, and then we start dropping? Or is this it? And we've already seen the end of a triangle, and we're ready to start dropping. And if that's the case, we are going to get bearish. Now, would I just buy puts? Probably not. The higher context is C of X. I might put a butterfly on that is skewed towards the downside, bring more negative delta in. And there's 2 ways you can do that with a balanced butterfly or a broken wing butterfly. Okay, we're just looking to get down to this level right here. Okay. Anything to add there, Terry, or do you want to bring in our special guest?
can do that. Just one more thing. The real key to the butterfly is taking advantage of the time decay, selling options with the time premium, and then allowing them to decay in your favor. The biggest thing is, if you're just out there buying a call or buying a put, it's your money. You're putting your own money at risk, and you own the time decay when you're buying those. When you sell an option, the buyer owns the time decay, and you take advantage of that. So that's one of the biggest benefits of the butterfly.
Good point. Give us 30 seconds to take a break for our sponsor. Terry, can you give someone credit and just do a commercial while I find this slide? I'm joking.
Who's your guest today?
Anybody want to promote? Tell them what's going on at the company right now.
Well, we've got a new COO. Andy's coming in, and he's got some serious corporate and programming experience. We're looking at some new and exciting features to be added to trading analysis soon. You've got an assistant.
Yes.
Joe.
We already. We talked about Joe.
So business is growing. Alex, we got to bring Alex in here. He's got a lot to say about cryptos and the Forex market. And if any of you guys have been paying attention to the crypto market lately, you've seen Bitcoin made a turn. We called the turn in December. And we've been progressing higher in what looks to be a longer-term bull market. Last week was very exciting for cryptos. We saw Bitcoin race above 8,000 for first time in a long time, and all the altcoins are proceeding well too. So now we're in a sideways consolidation with the crypto markets.
Yep.
Again, unfortunately,
like wave forward. Too bad we can't do butterflies.
Yeah, too bad we can't do butterflies in the cryptos. Maybe we can invent something and make our fortune that way.
Maybe we could be like Dr. Michael Burry, and we'll go to the banks and be like, write me a product. I want my own product. I want to short the housing market. No, just kidding. All right.
Maybe we can get ETFs. If they get ETFs, SEC did defer their approval of the VanEck ETF yesterday. They pushed that decision again till August and maybe October. So we're still hanging on that there's going to be some approval to get ETFs in our markets, and then maybe there'll be option plays.
One can only hope. All right, let's go. We're just a couple minutes behind schedule. Guest that I will bring in here in a second. I kind of mentioned it in the video last night. I don't know if you guys had time to see it yet, but my first job out of school, out of St. Lawrence and Albany, was a day trader. And I went to San Diego, California. I had family out there, and I studying for the Series 7 on the beach in San Diego, having a great time. And so my first professional job was day trading. So I learned to trade kind of in the smallest of time frames, scalping New York Stock Exchange listed stocks, listening to the S&P futures pit, specifically Ben Lichtenstein, who works now at TD Ameritrade. And, so that's how I learned to trade. And then as of, I guess that's 20 years later now, I'm pushing the time frame out further and further and further with swing trading and position trading and options trading and investing. And, I went from very short term to long term. So that afforded us the great opportunity to partner, have a co-working relationship with Elliott Wave International. Well, they've been working and promoting only one other person, like they've been promoting us, which was a huge honor, and we have some pretty big shoes to fill. The gentleman, the only other third-party company that Elliott Wave International promoted was a very active futures trader named Dick Diamond, and he has a 5-decade history, has a 5-decade career of actively trading the futures market even before they were S&P E-mini futures. He was a dear friend with Elliott Wave International's founder Bob Prechter, and he basically was instrumental in getting Dick Diamond out from just behind the screens to the teaching and to try to help people. So Elliott Wave approached me and they said, listen, you know of Dick Diamond. He's the only other person that third-party group that we worked with. Will you help get this course out there? Get his word. Unfortunately, Dick passed in 2015, so Bob Prechter mobilized the troops at Elliott Wave International, and they've got a big effort to go out and kind of continue on the teachings of Dick Diamond. So Vadim Pokhlebkin is the guy who was lucky enough to spearhead this project. Now let me just do this real quick. I can do this on the fly. This is going to be a job for Joe the intern pretty soon. See how quick that was? So here's Vadim. You guys have probably seen his work on Elliott Wave International. Just reading his bio here, spent most of his career working with Elliott Waves as a writer and producer for Prechter's Elliott Wave International. Over the years, he was involved in multiple projects applying Elliott Wave to trading. He had the good fortune to take one of Dick's live seminars, now helping other traders apply Diamond's 80-20 method as host of EWI's upcoming course, Trade Small, Win Often, the Dick Diamond method of trading for a living. So let me bring in Vadim. I'm unmuting Vadim. Go over here and let me bring him in. Vadim, welcome to the show. Can you hear me?
Good morning.
Please tell me you can hear me.
I can hear you. Thanks for having me.
Yes. Welcome. I'm getting pretty good at this technology. So, hey, how's it going? Welcome. First, just talk about working. How long have you been at Elliott Wave International now?
20 years.
20 years. Wow. Holy cow. You've seen...
For about half of its history.
Say that again?
For about half of the company's history.
Bob's been in history.
Yep.
Yeah. That's pretty amazing. Is the 40th year anniversary of Elliott Wave International. And you and I are just hovering around that for our entire existence on this planet. So that just goes to show the longevity of the company. So talk about what your experience kind of getting up to speed with Elliott Wave was, and what were some of the challenges that you had early on, and kind of how have you overcome them working in the trenches at EWI in Georgia?
Well, I started out in institutional sales when we had a department back in the early 2000s that we sold our company's forecasts to big firms.
Yep.
All the names that you hear in the news, and I would travel a lot to Europe and other places, New York. I remember having lunch at Lehman Brothers about 2 years before they folded.
Oh.
Right there on Times Square on the 40-some floor. It was serving as steak. So
I used to trade FX on the Lehman Brothers platform.
Okay. Elliott Waves are fantastic for what they are, and that better than most people. But it's not the only method to capitalize on market moves, and that's where Dick Diamond's method comes in. I first heard about Diamond probably just as I was starting with Elliott Wave in the early 2000s. I know we were promoting his live seminars. He moved by then from New York to Florida, to the beach, and he wasn't much of a beach goer, but he liked to play golf.
Yep.
And in 2005, I was invited to go down there and check it out myself. And I spent 3 days, 2.5 days with Diamond and a team of about 15 or 20 other students in the room where he talked about his method. And at the time, I was still learning how to trade, right? And I thought I had it all figured out. I was trading Forex mostly at the time, and Diamond traded exclusively the S&P E-minis, so I didn't see much of a opportunity to apply the system to what I was doing. Besides, what I was doing was just kind of opening a trade and hoping it's going to go in my direction, and if it didn't, well, so be it, right? Cutting losses short was not my thing. And then, years later, after Dick passed away and we decided to carry his legacy forward, I was asked to spearhead this project at the company, and I rediscovered the method for myself. And after so many years of getting beaten up by the market, it finally made sense to me. The brilliance of what Diamond was doing was reducing the risk at every step of the way. And a lot of people can make that claim, but Diamond took it to the absolute extreme. He called himself a scaredy cat. He did not want to be in the market for more than a few minutes per trade, 2-3 times a day. So he spent, 95% of the time not in the market, and would go only for the very short-term moves. And as he called it, grab his piece of the pie.
Yep.
And spend the rest of his time, doing something else. He liked to play golf, for example.
Yeah. And that's what kind of struck me. Just so you guys know, I'm going through the course. I've taken the course. Vadim has been studying this quite intensely, and I rely on him. He's got an amazing way of looking at the markets. It's so fun to kind of revisit my day trading days. But however, what I noticed listening to Vadim speak and reminding me, at the end of the day, we trade 50 times or 100 times, and I feel like every day was the end of a boxing match and just destroyed and beat up and exhausted. At 23, I was like, I can't do this my whole life. That's what it really kind of struck me with Dick's methodology is you literally, the first half of this course that I'm taking, it's all about EQ, the emotional discipline, the patience to sit quietly in the brush and wait. And you don't have to be actively trading. But as Vadim said, I'm trading it now. You're in and out very quickly with very specific indicator setup. So this isn't, a super fast back and forth trading exercise. So I just wanted to really underline that was such a key point. So please, sorry to interrupt you there. So in the course, which by the way, we're not, just so you guys know, we're not going to ask you if you want to participate. We will give you information on a webinar that's coming up here. There's going to be 2 webinars after. We're going to run short on time here soon, so we'll give you the webinar link here. Put some questions in for Vadim. But what are some of the challenges that you're finding besides having to wait and be patient? What is it like dealing with all these indicators? Because Dick used quite a few indicators in his day trading setup, correct?
He did, yes. He developed over his almost 5 decades of trading a number of what he called templates, indicator templates, where he would combine. It's all moving averages, actually. It's just a system of moving averages that several times a day would have what he called an 80-20 setup. 80-20 meaning that the odds of success on the trade were about 80%. So about 8 out of 10 trades, excuse me, would generally work out.
Yep.
The system itself, the system of indicators is simple once you understand it. The hard part for everyone, including myself, is the patience and the discipline, because you have to reverse your way of thinking. Like you said, most people try to chase every tick and every single move, and then they hit themselves if you leave money on the table, or you open a trade and it doesn't go in your favor, you get stopped out, and then the market takes off in your direction, and again you feel anxious and you try to revenge trade and so forth.
Yep.
Diamond spent half the course when I took it talking about the importance of emotional discipline, that you have to monitor yourself first. And if you ask him what the basis of his system was, he wouldn't tell you that it's moving averages. He would tell you discipline. The basis for my method is patience and discipline. He said, I'm sitting like a cat in the bushes all day long. Well, or whenever he would see a setup in the screen and just wait. And whenever everything is just right, he would jump in, literally sometimes for 30 seconds, a minute. You've seen it, Todd. You and I have done a couple of trades. And just as quickly he would jump out. That's it. So the benefit of it is that I'm not wasting my emotional energy. I'm not losing sleep. I'm not getting angry at the market and at myself. And it doesn't ruin my life, basically,
right.
Being a full-time trader.
You're just
Yeah.
waiting for the indicators to fall into place. It's not like you're not having to stress and worry. Oh, is the market? I'm trying to feel my way through the market. You're waiting for the indicators to set up, right?
Exactly. It's not a guarantee. It's not the holy grail of
Nothing
trading. Nothing is. But from what I've seen, and I've talked to a lot of traders over the years, as I'm sure you have, his method really kind of changes your whole lifestyle. You go from a nervous wreck, popping pills and checking your phone at 4 a.m. when you go to the bathroom, to see what happens in the futures, to just not even looking at your phone after the market closes. Because Diamond would never hold a position overnight. He said, I sleep better. Why would I do that? I have one of the templates here on my screen if you want to share it.
Yeah. And while I'm popping up your screen, he was a Marine, correct?
Yes, he was a Marine. So he had a lot of discipline, and that's probably where his success comes from.
Right.
His dad owned a seat at the American Stock Exchange back in the 60s. So he started out in the markets, and in the 60s, he made a lot of money just buying stocks because it was a bull market. He thought he was a genius. And then and this is what he says about himself. I think it was 67 when the market turned and he lost 70% of his capital. He was doing really well up until that point. That's when he realized that he wasn't really trading. He was just buying and holding.
Yeah.
And to be a real trader, you have to be able to go long and short. And so he changed his approach entirely and traded stocks and options for a while. And then, in fact, in the course, he does talk about trading options a little bit.
Yep.
And then in the early 80s, when the S&P minis came out, he switched to that instrument, and he said he never looked back since. So right now, what you're seeing on the screen is one of Dick Diamond's indicator templates. This is Trade Navigator, which is the data program we use in-house at LPL International. And the folks at TradeNav pre-programmed 6 templates. You see these tabs here at the bottom of the screen. Each one has a separate template of indicators. This is S&P E-minis. This is the live price chart. And all you're doing as a practitioner of Diamond's method is you watch to see when these moving averages cross each other and the price in a certain way, and then you're waiting for the confirmation from your additional indicators right here. I'm not saying the names of the indicators right now because we're saving that for the course, obviously, but this is something that you can find in most trading systems. It's not something that Diamond had built for himself or anything. This is very common indicators. He talked about, for example, watching for divergences. This morning, right before the open, we're talking about this, Todd. The market took a tumble, went to about 28.48. Well, look, his indicator right here at the bottom had a bullish divergence at the time. And Diamond said, watch out for divergences. Whenever you see this, go with the indicator. And look what the market did.
Yeah. Yep.
Recovered completely from that sell-off. That's just one example of how he would watch the market.
And to tie it back to the Elliott wave component of what we do in our professions, Bob Prechter did say, I believe maybe Dick didn't know it or didn't verbalize it, but in fact he was trading kind of micro third waves. He is looking for the momentum moves to be out very quickly. But is that fair? Is that I know I heard that coming through the corporate offices. Is that fair to say?
I think so. What Diamond waited for were these moments in the market when most people would be looking in the other direction. So he was looking for the overbought and oversold conditions shown by the indicators. And he would jump in at the moment when the market was at this extreme emotion, which in Elliott wave terms would be the third wave or maybe the end of the move, like the fifth wave potentially, but it was still a very heightened emotional moment for the market, which would not last long.
Right.
And that's the reason why Diamond would only jump in very quickly into the market. But the odds of the win were so high because the market was all committed to that one move in that direction. But, Diamond said that he would, every once in a while, he said he would catch, 5-6 points on the move, but those were his home runs. He would mostly make his, day trading by jumping in for 1 point, 2 points, sometimes 3 points. He would do it on a maximum of 10 S&P mini contracts.
And he was
2-3 times a day.
He was, sorry to interrupt, but he was professional trading. He left his corporate job. He was trading for a living. He's got a long,
Yes.
right.
Him and Bob Rector met at the Merrill Lynch back in the 70s. He was one of the traders at Merrill Lynch, and Bob was at Merrill at the same time.
Yep.
And then Dick began trading full-time, and Bob was one of the people who convinced him to teach the method, and it took him a while to actually do that. He wasn't looking for fame.
Let me get this link out here, Vadim. This is just, I keep you forever. The bell just rang. But listen, guys, we have 2 webinars coming up here. You should see it on the screen. Go to this link, which is trading analysis, you know that, .com/diamond. T is, okay. Yes, go to that link. And what's going to happen, guys, is we have 2 webinars coming up for more information. Yes, this is going to be an offer. If you'd like to get into this training, this will be an information-packed webinar. So go ahead and sign up. There's 2 dates. Vadim is going to be doing one on his own Thursday at noon. Correct, Vadim?
Yes, tomorrow at noon we're having a frequently asked
Thursday
questions.
already.
Yes.
Oh,
we're getting a lot of questions from potential students. We just finished the first course, which began in February and just wrapped up in early May, and we're starting the second course, and we're getting a lot of questions, so we figured just let's have a webinar and answer as many questions as we can.
Okay, perfect. So the first webinar is going to be Vadim only tomorrow at 12 p.m. Eastern Time. The second one will be with Vadim and I. Do you know that you're going to be in this one yet? You do now. Vadim and Todd and a special guest. That's going to be June 5th at 8 p.m. Okay, so all information, questions we will address here. So go ahead to this link, tradinganalysis.com/diamond. The main webinar that we are promoting will be this one. As the second page, it will give you access to show you how to get into this webinar tomorrow. Okay, if this is something you guys are interested in. Yes, I know, quite a deviation than what we normally do here on the Wednesday webinar. We're Elliott Wave based, but this is close to Bob Rector. He was a good friend of his. He wants to continue on the legacy, put the teachings out there. So obviously Bob came to Vadim, myself, and a lot of the team at Elliott Wave International to get this out here. So that's what we're doing. I'm taking the course. Vadim's being my guide. I'm going to be in the course here. There's going to be one coming up here a couple weeks from now. So if you're interested, have at it. Okay, Vadim, thanks so much for being with us, and have a great time on the webinar tomorrow. Wish I could be with you, but I will be with you 2 weeks from now. In between, you are doing a vacation, you lucky dog.
Thanks for having me.
No problem. I'll talk to you soon, man. Okay, so let me bring back in Mr. Terry Long. Boom. Good. Interesting, right?
That was really.
We have a lot of time in between our positions. We're longer term position traders in the option markets, and we're all running a business, and that kind of sometimes gets in the way of trading. If I wasn't running a business, I would be more actively doing these short term opportunities. In fact, I definitely would. So, what do you think there, Terry? Any takeaways from that?
Looks like an interesting concept. I'd have to see the nitty-gritty details to get better at it. But day trading is not for everybody, and certainly jumping in and out real quickly, you've got to have discipline, and I can certainly attest to that.
That is absolutely the truth. Absolutely the truth. Okay, perfect. So let me just flip this over, Terry. I don't have you set up on the other screen. It's still sharing on Vadim, so I'm just going to go on a desktop capture here. But let's see. Terry, I appreciate you joining me, and I'll see you here in just a couple minutes for the member webinar.
All right.
Sounds good.
Looks like the market's opened down a little bit.
Yeah. Yeah. Okay. So yeah, futures down a little bit here, 0.25%. Oops. I don't know what I'm doing here. Guest call. Let me mute audio. Okay. So yeah, guys, we market's moving down here a little bit. If we get any more evidence that we are going to push lower here, we're going to look on the short side, as I kind of mentioned. That's our main takeaway. So let me just get my house in order here. There we go. All right. So guys, again, thanks for listening. Hopefully that was helpful. Drop a like with that little thumbs up if you could, if you appreciate it. Drop a question, comment, insult below there. Members, we'll see you here in a little bit. Hit us at tradinganalysis.com for more information. Lots coming up. Lots of fun stuff. Stay tuned. I think volatility is about to pick up as we start to get out of this sort of consolidation. And we should be on our normal schedule here going forward. I'll see you on Fast Money, CNBC Fast Money tomorrow. And happy trading, guys. We'll see you soon. Thanks.